With that said, we are up for John Maddox of Sunstone Properties. Um, John, are you on the line with us?
I am.
All right, great. I'm gonna just transition here um, to a different presentation. If you give me 1 second, and um, I believe that your camera is working um, fine, and I am going to pin the camera so that people can see your actual projection well. All right, so um, you're pinned to the everybody's screen right now, and if you like, I can put your presentation up. It's up to you.
Yeah, I think what I'd like to do is just speak live camera. Um, Everyone's probably getting a little bit tired of just looking at an image on the screen, and so let them see a live person for a bit. Um, so if it's okay with you, Michael, I'll just continue.
Yes, that'll be perfect. That'll be perfect.
Okay, great. Well, I appreciate the opportunity to be with you today. I'm speaking to you live from Westlake Village, California. You can see our office here in the background. My plan is to not to share slides with you today or speak from a fixed image, but just to visit with you about 6 topics that just, what are our thoughts on them, and how do they affect our business, and generally, what are the issues that we're thinking about. We are Sunstone Properties Trust. We're focused on value add, opportunistic, as well as development, primarily in the multifamily space. We do own some industrial assets and some office assets, but our business primarily is residential and primarily multifamily. I will not be sharing today an investor presentation. If you would like to receive that invitation, uh, that information, please contact Cheryl Moorhead or Isaac Robledo. Their information is on our website at www.sunstonept.com. So we have about 25 minutes together. I'll share some thoughts on these 6 subjects, and then if we have time for questions, we'll do our best to answer them. So what are we seeing out there in the world right now? Well, we know we're in a global recession. The global economy has regressed about 4.4% thus far in 2020, according to the IMF. This is the sharpest, most severe drop in global productivity we've seen since the Great Depression, and we're all feeling it. China's economy is waking up. They contracted about 6.8% or more severely than the world in the first quarter of 2020 compared to the first quarter of 19. But in the third quarter, they've grown about 4.9%. Their economy is restarting, probably because COVID started there sooner, and also because the government took very strict measures to shut down their economy and try and prevent the spread of COVID. The IMF expects that the US economy will shrink in 2020 about 4.3%, as compared to France at 9.8, or Germany at 6%, or Japan at 5.3. The Gulf states that are having the double impact of low oil prices as well as the COVID impact, they'll probably shrink their economies about 6.6%. So all of these things impact us, particularly as factories have shut down in China with regard to the production of commodities and finished products that we're all using. And I'll talk a little bit about that in a few moments. So what's going on domestically? Well, we've had the unprecedented stimulus package. And interestingly enough, FICO scores, a bit counterintuitively, are up to an average of 711, up from 708 in April. So what does that mean? It means consumers are spending a little bit less. They're taking unemployment benefits and stimulus benefits and other resources and paying down debt and restraining themselves with regard to purchases. But with regard to someone who's running multifamily properties, if you have an applicant coming in the door with a great FICO score, they may be unemployed. They may have some coming cash flow issues. So it's important for us to verify their cash flow and their income more than ever. These consumers have been benefiting from some credit card holidays and some mortgage payment holidays. And it's important for us to understand whether that's going on. In September, single family housing starts rose about 8.5%, most of those in the South and the West. There's been a migration from urban areas to suburban areas and even rural areas during COVID, as individuals have sought to leave central business districts and more urbanized areas to get a little bit more space. Since they've been restrained in going out to dinner and other entertainment venues, they've sought more personal space. Multifamily starts are down in September 16.3% and 25.9% in August, but they grew in May and in June and in July. So there's some seasonal adjustment going on there. There's been a decrease in the demand for luxury apartments in urban areas. Workforce housing has remained pretty constant. We sometimes refer to that as B-class housing, but the luxury apartment demand is diminished. And the new multifamily starts are more suburban than urban. Unemployment is now at about 7.9%. Every major market has had negative job growth, and every secondary market has had negative job growth. But the markets that have had the least impact to job loss or have had the least job loss are Phoenix, Jacksonville, Dallas-Fort Worth, Kansas City, Tampa, San Antonio, Atlanta, and Salt Lake City. So the secondary markets that are technology based for the most part. Some temporary job losses have become permanent, and we need to take this into account when we're looking for properties to buy, and also keeping in mind with regard to our operations. Disney's laid off 28,000 employees. American Airlines, 19,000. We saw today that Cathay Pacific is going to cut their workforce. United Airlines, 13,000 employees. MGM Resorts, 18,000. And City World shutting down all their theaters, 40,000 employees. Back in January, we looked hard at an asset that was very close to the DFW airport and American Airlines new headquarters, and gratefully so, we didn't buy it. But one of the reasons we didn't buy it is we were concerned about the focus or the concentration of American Airlines employees in the area. During COVID, in advance of COVID, when we saw the COVID wave coming for the properties that we had that were under construction, we stocked up on materials. Our instructions to our construction team were, let's get at least 6 months worth of inventory on site so we don't have interruption with our supply chain and have to slow down or stop construction. We were able to do that, and most of our suppliers gave us assurances that they would be able to continue to supply us. But what we found out is that largely has been true up until the current month. We are now experiencing some difficulty in getting lumber, and we are experiencing some difficulty in getting appliances. We've sought to reorder every 2 weeks as we needed additional product and to maintain those inventories. So what's happened with wood? One of the previous panelists spoke about it. So January through May, commodity prices, which are priced on a certain amount per 1,000 board feet on the Chicago Mercantile Exchange, was about $400 per 1,000 board feet. From June to September, there was a dramatic price rise. Why did that happen? Well, a number of folks that were holding inventory were concerned that their inventory wouldn't pull through the system, so they stopped ordering. A number of factories either had COVID issues or they just shut down because they didn't think there would be as much demand or reduced supply. Some of the normal flow that's happened from Canada to the United States in terms of lumber, has been impacted by tariffs. So what happened? The price went from about $400 per 1,000 board foot to $948 at its peak. When I last checked 2 days ago, it's about $535. So single family home builders have reported increases of $3,000 to $4,000 on the low side to $16,000 price increases in home cost on the high side. Those of us that are engaged in ground up development or value add renovation, it's adding cost to our renovation and construction projects. We expect some of that will flatten out seasonally and continue to come down as more production comes online. But housing starts are expected to continue at a high level, and there will be demand. And factories are close to operating at capacity now. So what have we seen in the debt markets? Well, the debt markets have generally tightened. A number of the lenders that have consistently been in the market are out of the market or in the market only in a limited way. Often they'll tell you they're in the market, but they aren't in the market like they were in the market. Some lenders have required that you have additional debt service reserves for 6 to 12 months and other COVID-related reserves. Fortunately, the agencies have been in the market in a significant fashion. Their originations rose $39.8 billion in the second quarter of 2020. That's a 14% increase year over year for the same quarter. It'll be important for us to watch to see how their business is capped going forward. Several debt funds are active in the market and taking advantage of the opportunities of some of the other banks pulling back. Fortunately, we chose to finance our portfolio on an interest-only basis and on a floating basis, and we're covering our debt service coverage at about 2.17 to 1. So how is monetary policy impacting us and impacting the industry? Well, the Fed has signaled that low interest rates should be with us at least through 2023, even if inflation rises above target rates. The United States government has significant debt. That debt has risen through the stimulus packages and through COVID. And a new stimulus package is being discussed. Obviously, it's not clear that it's going to happen before the election and may well not. But there may be one subsequent. And it's important for the government to finance their debt at a lower interest rate. And so I think there will be continued focus on keeping interest rates in, and I think other countries are in the same boat. And so that will help us. So cap rates, let's talk about cap rates for a moment. Multifamily sales volumes are drastically off. In the second quarter, they were off 70% on a quarter by quarter basis year over year. And so our data is limited. There's still some price discovery that is going on. The other thing that's going on in markets that have been reporting compressed cap rates, that's probably has a lot to do with reductions in income assumptions that we're making, and also peeling back what we think the real income is to take into account loss reserves and enhanced losses because of job loss and job hour reductions. And so that's causing a little bit of an artificial impact on some cap rate compression. Multifamily cap rates nationally in major markets are about 4.7% and about 5.6% in non-major markets. Value add cap rates are less than that, about 4.6% to 5.25%. Why are they less? Because there's an expectation you'll be able to create value and force rent growth through the value creation process. You're delivering a higher quality apartment to a tenant who's willing to pay more for it. With average cap rates at about 5.3% and a 10-year treasury at a historically low rate. When I last checked it, it was 78 bips. It makes multifamily investments attractive to investors. Many of them viewing it as an inflationary protected bond-like return. So, 24 months ago, we were very focused on cap rate expansion. We would underwrite our acquisition models with as little as 50 basis point widening to as much as 150 basis point widening. And we flattened that out significantly. We think at least for the next 24 months, there will be little widening of cap rates. We do recognize that cap rates are closely tied to interest rates. And with interest rates being flat for the foreseeable future, we expect cap rates to be relatively flat as well. Now, Obviously, that will change geographic area to geographic area and will change asset class to asset class. Obviously, for CBD office and also for regional malls and non-grocery anchored retail, it's going to widen. So what are some of the things we've looked at on the asset management side? Well, we've had our amenity areas closed largely till COVID. They've been reopening generally, although in Texas this week we shut them down again because of the spike in some of the COVID cases there. Um, One of the challenges we've had is keeping our on-site staff motivated and ready to show to work up to work every day. Obviously, they have concern about catching COVID and bringing it home, and so we've had to figure out how to interface with prospective tenants on a much more effective basis. We've become better at some things like virtual tours, taking our very best leasing agents and having them give the very best tour and putting that online and sharing that. And we found that we've been able to effectively lease apartments that way. Tenants have not been moving around as much. Our tenants have been much stickier. Typically, about 53% of the tenants stay, and 47% of the tenants are moving every year. And we found that has escalated to a retention rate of approaching 60%. And for that, we're very grateful. We have seen an escalation in the last 45 days of on-site traffic as people have been out thinking about making a move before the holidays come in. Occupancies have been largely good, and I think that's because people haven't been moving around as much. We've been striving to protect our on-site staff with personal protective equipment. We've had to modify going into units and how often we do that, and what kind of protection and notice we need to give to tenants before we do that to do repair orders. Well, let's talk for a moment about rents. Rents have regressed in every market. Collections have been relatively good. Multifamily is the only asset class where collections have been above 90% for every month since April. But the rent collections have been the best in non-major markets that have had, tech jobs: Austin, Denver, Sacramento, Salt Lake City, San Diego. Rent growth over the last 12 months has been 2.1%, but on average, it's regressed in the second quarter 1.5%. Some major metropolitan areas like San Francisco and San Jose regressed between 6.7 and 6.8% negative rent growth. The CBD areas have been hit more than the suburban areas. So where do we see stress? Well, in the obvious places, CBD office. Although the CBD office landlords, CBD office tenants have been able to continue their business largely with having their workforce work from home. So from an income perspective, while there has been an impact, it hasn't been as dramatic an impact as having a regional mall closed for 6 or 7 months, or retail tenants closed for 6 or 7 months. So major impacts to malls and to strip centers and other retail centers. Hospitality. We've all read a lot about the impact to hospitality as well as the CBD office opportunities. So where do we see some opportunities moving forward? Well, most of the lenders that we've talked to, as we've inquired about distressed debt, underperforming debt that they're watching, they expect that in 2021 that there will be debt available. Lenders are organizing their restructuring workout groups. They're primarily focused on hospitality and retail assets and some CBD office assets. We've seen some of the CMBS loan bonds being repriced in New York, and there's some opportunities there as well. It's interesting, and I'll share this case study with you just as an illustration of where we might look for opportunities. During the GFC, which really had its most severe impacts in 2008, we didn't really see great buying opportunities until 10, 11, and 12, and I expect that we'll see the same now. Many of you may have heard that the Angel Stadium, where the Anaheim Los Angeles Angels play, um, recently sold. Um, there was a transaction that was announced last December with a purchase price of $325 million, and that is a sale to an affiliate of Arte Moreno, who is the owner of Los Angeles Angels. Interestingly enough, the city of Anaheim had an appraisal at $500 million. And this transaction included not only the stadium, but 150 acres around the stadium. It's interesting to compare that Stan Kroenke spent $5 billion building SoFi Stadium. Now that, of course, is a state-of-the-art stadium in Los Angeles where the Rams and the Chargers are playing. The transaction that was made was for $150 million. It's interesting, $150 million in the face of a $500 million appraisal. In a previous transaction, it was discussed and closely almost agreed upon at $325 million. So what happened? Well, the spin that was put out in the press was Arte Moreno agreed to build 500 affordable housing units. But what will that take? 20 acres, maybe less than that. And developer fees can be as much as 15%. So I don't think he's going to lose any money on the affordable housing. But the interesting fact that wasn't published at the same time was that the city of Anaheim just announced that they have a $75 million budget shortfall. So what is the proposition here? The proposition is that deals are made when sellers have unusual motivation to sell. And I think that's what we have to look for. So what are some other opportunities like the city of Anaheim? Now, they did extract from the Angels an agreement to play there for 50 years, but where are they going to go anyway? And I don't think they're going to move out of Orange County. So other opportunities, open-ended funds that have redemptions. They're going to have to generate liquidity to fund those redemptions. What assets do they have in their portfolio that you may want to buy? Multi-asset funds that are having difficulty in their retail and mall and perhaps CBD office. What else do they have that you may want to buy? The state of New York just announced that they have a $58 billion budget hole. States have lots of real estate assets. So with that, I'd be happy to take a look here at some questions that may have come in. Yeah, so one of the questions was, collections have been good in the secondary markets, but how much of this is supported by stimulus and unemployment benefits, and what's going to happen when this runs out? I think that's a great question. We're asking ourselves the same question. How much impact is there going to be as unemployment burns off and stimulus gets burned off? Well, one of the things we've done is we've gone out to every tenant and inquired about their own personal situation. What's going on with regard to their job? Have their hours been cut? Were they furloughed? Are they concerned about job loss? From any tenant that has been, had difficulty paying or paying on time, we've tried to put them on a payment plan. And almost in every case, we've been able to achieve that. We do have a few tenants on every property that we've not been able to evict because of a moratorium, or they just have simply not been able to pay. So I would say in our portfolio, the lack of stimulus is probably not going to be it burning off, or lack of new stimulus is probably not going to be material. But I think that there are C-class assets out there that have high occupancy of service workers that will be impacted, at least to a certain extent. Let's see if there's maybe one more question that we can address. I think that's it. So with that, Michael, I will turn the time back over to you.
Thank you very much for your presentation today. We really appreciate it, and it was extremely insightful and well thought out, and different than the rest of the presentations that we've had since we started this. It's 100 hours. You're the first person that did it freestyle, and I give you credit for that. Thank you.
Thank you, Michael.
Have a good day. what's coming up next here um, is Nate Goodhart. He's with Applied Business Software, the mortgage office. I want to thank all of the sponsors and members of Flya. Um, our organization takes a lot of pride in what we have done over the past 9 months since COVID came on the scene. We've been very active. This is the seventh event on this topic in 2020. We were forced to have to reinvent ourselves. Fortunately for us, we didn't have to reinvent ourselves this year. It was pre-COVID, and we rolled out a lot of digital solutions, and those digital solutions have helped our members significantly, and the support that the not only the members but the participants in the past seven events has been exceptional. So I want to thank everybody for being involved with Flya and this series. Without your help and support, this would not be possible. Um, Check out our marketplace. It's flaia.org/marketplace. There's a lot of exceptional firms that are listed there. We have part 8 and 9 of our real estate direct lending private debt forum coming up here November 19th and December 17th. As the conversation continues to unfold, we will bring it to you.